Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Jim Bianco of Bianco Research is watching 10-year bond yields and writes the following. If rates are steady, then 10-year bond yields should continue sideways before heading above 5% and the curve will steepen. Jim joins us now for more. Jim Bianco, I want to go to a quote from Michael Hartnett of Bank of America and get your thoughts on this take this morning. We say hot 3% US CPI in January is a blessing in disguise for both bonds and stocks. Michael and the team go on to say rising inflation means Trump must go small, not big on tariffs and immigration in the coming months to avoid fanning a second wave of inflation. Jim, would you agree with that take?
No, I would not. I mean, we all know the phrase is you're supposed to take Trump seriously, but not literally. And that's what I think we've seen in the market in the last 24 hours. They're torturing themselves to basically, micro read what Trump has said, but take him seriously. He intends on doing tariffs, and we are going to get tariffs, and they're going to come. And as much as we want to try and talk ourselves out of it, they are coming later this year. And I might add, markets get things wrong all the time. It convinced itself in January 2020 COVID wasn't going to be anything, and it was. It convinced itself in August of 2020 that, the yen carry trade unwind was the biggest deal we've ever seen, and it wasn't. So it gets things wrong a lot, and take Trump seriously.
So, Jim, with that in mind, as you look at bonds and stocks, and you look at stocks close to all-time highs and bond yields near the low end of the range for the year so far, what do you think is more vulnerable?
Oh, I think the bond market is probably more vulnerable at this point. The hot CPI number, I think, is still a tell that at least at a minimum, the road to 2% is now, we've been talking about the last mile for 2 years, and we're probably going to have to talk about it for another 2 years before we get there to 2%, that we've got sticky inflation. And if we've got sticky inflation, the Fed is probably going to be done cutting rates, if not maybe one more this year, although I think they might be done for the year, meaning that the funds rate is still going to end the year with a 4 handle on it, even with one more cut. And if the yield curve continues to steepen and we see some kind of normalization of the curve, which we've been seeing for the last several months, that means that you could be pushing the 10-year yield above 5% sometime later this year. And I still think that that's in the cards.
Jim, when you take a step back, it feels like it's a little bit of a numbing environment. There is so much noise. You have on one hand, about 3 days ago, we were talking about that inflationary risk, and you would have had a lot of compatriots talking about 5% treasury yields. At the same time, you got inflation data that looked bad on the surface, but people got enough comfort from the individual details to say, actually, this means that disinflation is intact. How do you strip out the noise and have conviction about an inflation call and the possibility of expectations getting truly unmoored?
Well, I think if you look at the way that the markets have been trading, and if you start with the stock market, the S&P is at the higher end of a range it's been since 2 weeks after the election. It's been trading in about a 5,800 to 6,100 range for, like I said, over 2 months, and it's just at the top end of the range. And the same thing has been happening with the bond market, too. On November 15th, we were at 450. We're 453. We ended the year at 456. So there's a lot of noise, and the markets move around a lot. Yesterday was a big individual day in the stock market, but the trend is still sideways. And that says that that's still a market that is, has little conviction or is unsure of where to go next. So it sees all the news, and it's not really reacting to it other than having big days here or there, but moving sideways. And I think ultimately it's going to give away to there's going to be tariffs, there's going to be a little bit more inflation, and interest rates are going to go higher.
Jim, when you talk about the inflationary impulse, are you really attributing that to policy? Or do you see something in the internals of the data that a lot of people are just dismissing as highlighting some sort of pressure that everyone is closing their eyes to?
No, I see something in the data. Every time we have a financial crisis or recession, and we had both in 2020, the economy changes. Change is not worse. It's not dystopian. The big change that happened in the economy coming out of 2020 was remote work. Over a quarter of the country is now doing remote work, and we know what Jamie Dimon's attitude about that is from a couple of days ago. He doesn't like it at all. But it is here. It is not going away. And that is a fundamental change, not only to the way we work, but also to the way we live our lives. And I think that that is building excess pressures on prices and leaving us with higher inflation. Not 8, 10 or Zimbabwe inflation, but more like 3 to 4% inflation. And core CPI just finished its 45th month in a row above 3%. So we've been seeing that kind of pressure, although we continue to try and tell ourselves that, no, we're going to go back to 2%, that, we're going to return, as Jay Powell says, to a pre-pandemic environment. The cycle changed, and we're in a different cycle right now.
Jim, I just love to quickly get your thoughts before we end on what you actually think is going on with tariffs, because you say the market should be taking Trump seriously, and they didn't, but he didn't actually sign anything formidable yesterday. It's an investigation into these countries. There was not a single tariff placed yesterday, and my read is that he's in negotiating mode to get some sort of concessions, especially out of the European Union. Would you not agree with that?
Yeah, I think tariffs are leverage, and I think they are big leverage. And I think that when it comes to negotiating with our partners, whether it's Canada, Mexico, or the European Union, Trump holds more cards than they do. And I think that these tariffs are a threat, and he wants something else. Now, in the case of Europe, I think what he wants is he wants more security arrangements. He wants them to spend 5% of their budget on defense. And he even said yesterday he wants them, when they're spending 5% of their budget on defense, to buy more stuff from defense makers in the United States. So I think that all of this is more leverage than an external revenue service to raise revenues. I think he wants some of that too, but I think it's really about negotiating, and we need to understand that that's what he's trying to do.
Hey, Jim, great to kick off this morning with you. Appreciate it. Jim Bianco there of Bianco Research. Tchir of Academy Securities saying maybe we need to squeeze some shorts, but I suspect we're going to see tariff-related headlines that spook the market as early as the next week. Pete joins us now for more. Pete, good morning. It's good to see you. What happened yesterday? Should we start there?
Yeah, I feel like it wasn't really Donald Trump speaking. I feel like he got sucked into by his advisors to come up with this very mellow message, right? If you think about Trump, it's we're going to take over Greenland. Canada should be the 51st state, right? There's no nuances about, well, Quebec doesn't like Ontario. He's always very aggressive, even on the initial set of tariffs. So I feel like the rest of the world is kind of like, okay, what was really said? And I do think tariffs resonates with people, trade protection resonates with people. I'm not even sure VAT resonates. So I feel that sometime next week he's going to be like, no one's taking this seriously. I'm not going to listen to my advisors. I'm going to go back to being myself, and I'm going to send a clear message.
I'd love to have Putin back in the G7. Russia should be sitting at the table. That was the restrained version of the president yesterday.
So that was an interesting one. I think it's, again, you go back, and why Russia was brought into the G7 or G8 at the time was, okay, maybe if they work with us, they'll move forward. I think it's a little bit incorrect right now because there should be some sort of punishment for the invasion, and certainly this is going to send Europe, in a tizzy, right? Europe's not going to be comfortable with this at all. Europe's not comfortable with any form of peace right now, let alone bringing him back. So again, I think there's all this friction, and I think people have been very
Hold up,
calm.
Let me jump in. Europe's not comfortable with any kind of peace right now. Can you translate that? Because that just sounds shocking to people. What does that mean?
I think Europe, much more than us, is very worried about if you give Putin an inch, you've given him a mile. And that's any sort of accord that gives Putin time to, take his win, consolidate, leads him coming back for more in 2 years down the road. That's, I think, very prevalent within Europe. It's a thought that's much more concerning to them, and they are sitting there much closer to the front lines. So I think their view of a peace is very different than ours.
Which is the reason why a lot of the commentary that we hear out of the European Union, as well as analysts in the United States, is this doesn't really move the needle further towards some sort of peace agreement that is viable and long-lasting. You have a lot of generals. at your firm, at Academy Securities, do they agree, or do they think that actually having conversations is a really solid step, just like the market seems to imply?
So we think there is going to be a deal done this year. I think whether Europe likes it or not, it's going to happen. We think that the Russian frozen dollar reserves are going to play a big part of that. So that's going to be the carrot and stick, right? Putin, we could try and fight you and keep all these dollar reserves, or we can give you some back. And if you make peace, Ukraine, you get a bunch of dollar reserves to give up some land and do the rebuilding. So I think that's a big part of it. There'll be some sort of vague path for for Ukraine to head towards NATO that Putin probably won't believe in. And there's a chance, right? If you pull people together, I think most of our generals, again, I think one of the more interesting questions we've been asked, period, what would you do most as a general to ensure peace for the U.S.? And he's like, fund the State Department more. So I think talking and engaging with countries, that's a way to pull it together. So I don't know that there's an obvious lasting peace, but if you stop the war, you get people talking, there's that potential.
Markets are sniffing this out, and there's a question of how much that is giving sort of a turbocharged effect to some of the optimism that we heard a couple months ago about the euro. Maybe things have gotten so bad they can't get any worse. Do you lean into that? And it's not just with Europe, but also with China, that if there is discussion and there is some semblance of deal-making, then maybe that could actually reignite some of the growth in the rest of the world, not just the U.S.
So at the start of the year, we were very adamant. We called it geopolitical opportunities and risk. And I think everyone talks about geopolitical risk. We felt there'd be some sort of resolution this year in Ukraine, Russia. There'd be some sort of resolution with Iran, Israel. Those are going to be very positive for those regions. I think Germany can actually, this might help Germany out of the slump, especially if Ukraine's given these dollar reserves to rebuild. Poland, I think, is going to be a huge beneficiary of this. I think in the next few years, you're going to see Poland's importance grow more and more. And even when Vance talks about pulling troops out of Germany, at least in the past Trump administration, it was pulling troops out of Germany and putting them in the Baltics, putting them in Poland for two reasons. One, closer to Russia, so more important. And two, this goes back to Trump. Having a U.S. military base in your country provides huge economic benefits to that country, right? The military spends money. The people there spend money. So if Germany's not spending their 3%, let's give it to the Baltics, who are spending their 3%. Let's give it to Poland, who's done a lot. So I think there's going to be a lot of, thought about this, and it's not simplistic.
Do you think that maybe then the long dollar trade is crowded? Because right now what we're seeing is actually a push toward the rest of the world. Get your house in order.
Yeah, so I would say right now the portfolio we're recommending people is very contrarian, but we still like, despite all the friction that we see with China, despite China as national security threat number one, FXI and KWEB, I think, are going to continue to do well. They're heavily under-owned. China's trying to do its own thing. Trump seems to back off on them periodically. I think that could explode higher. I like European stocks. And I do like the chip makers in the U.S., but I like the ones that can be domestic chip makers. I think you're seeing more and more of this. We've been talking about it since day one of Trump. He wants a domestic chip industry. We need to be able to make chips. That's going to be part of national security. I think that's just starting to take off, and we've seen some, single stock reactions this week that I think are just the beginning of what can come.
Everything you're saying to me, I keep thinking Trump is very transactional. This nuance, this idea of pulling troops out of Germany, but not to pull them out of Europe, but put them in the Baltics. Isn't that what the Europeans are? Going back to Jonathan's point, Trump yesterday saying he'd like to see Putin back at the table to the G8. Well, Russia was kicked out because of annexation, illegal annexation of Crimea. At the same time, Germany was still willing to build Nord Stream 2 years later.
Yeah, and one thing I would say, I think one thing Europe's getting a little bit ahead of itself. I don't think Russia's coming back to deliver cheap gas to Germany anytime soon. I think Russia's really moved on. They're like, well, China's going to be a better customer. India's going to be a better customer. They're both going to be buying fossil fuels for 50 years in the future. Germany wakes up every day saying we're not going to use fossil fuels ever again, and then uses fossil fuels. So I don't think you're going to see this, return to what it was. That switch has been broken. It's not coming back. I think the U.S. has a better chance of establishing relationships with this. And the other thing I think you pointed out earlier is, tariffs. Trump is going to be carrot and stick with everyone. Here's what you get if you behave nicely. Here's what and that may work. It may backfire. That's going to be the big question.
So right now, what do you think he wants, his major concessions when it comes to tariffs?
I think he does want something that allows U.S. manufacturing to grow, something that makes it easier to build things here. And of all things we look at, I think the one he's most committed to and the one where we might get subsidies is the chip industry. I think everything else would be nice. I think that's a must-have. And so when you think about must-haves, it's the chip industry.
You said the G8. Who said it would be the G8?
You're thinking Canada gets kicked out because they'll be part of the 51st state, so then it's still the G7?
I'm just staying open-minded about
I know that's what you're thinking because you said it to me yesterday.
Look, the pressure was building in the news conference again on Canada yesterday, wasn't it? What's that all about?
You know, I think, again, that's why I found what he says about Canada, for example, versus what he did on global tariffs so interesting. So if you're Canada or Mexico right now, or even to some extent China, you're still facing the first round of tariffs and your fentanyl negotiations. Then you got slapped with 25% on aluminum steel, and now there's this vague talk about reciprocals and VAT. What are you even negotiating now? I think his message was too muddled yesterday. I think markets took it comfortably because, okay, this isn't going anywhere. I think that's where he gets disappointed in the next few days when people don't show up to kiss the ring, don't come saying, hey, President Trump, what do we need to do? And that's when I think he ups the rhetoric, because he does want people to come to the table. I just don't think yesterday's message brings people to the table.
Right now, the market's not taking it seriously, that's for sure. Pete, it's good to see you, as always. Peter Tchir there at Academy. Let's get to Jeannette Lowe of Strategas, who joins us now. Jeannette, I think the tough question, what do you say to clients at the moment who ask you, Jeannette, what do you think is going to happen on April 1st? What do you tell them?
So I think the one thing that we've noticed is that it is important to have a difference between tariffs on China and tariffs on the rest of the world. We have noticed that Trump has proposed tariffs several times in the beginning first 4 weeks of his administration, but only the tariffs on China, the additional 10%, have actually gone into effect. Everything else seems to be up for negotiation. So we did have Canada and Mexico already negotiate. We had Colombia already negotiate. They're setting up a time frame saying you have basically until April 1st to start making some offers. Obviously, you had Prime Minister Modi coming into Washington yesterday. He came ready to offer some things to Trump to try to fix that reciprocal trade relationship with the U.S. And also the fact that these tariffs were announced while J.D. Vance is in Europe for the Munich Security Conference is also important to try to say, Europe, you need to do something to change the relationship with the United States.
Well, Jeannette, we do have the head of the European Parliament Trade Committee saying that they're willing to lower the tariff when it comes to autos. What else could Europe give the United States in terms of concessions in these negotiations?
So I think definitely the autos has been a thorn in Trump's side for quite some time. So getting that rate down from 10% to closer to 2.5 and matching the U.S. rate would be quite important. Obviously, U.S. LNG has also been really important during the entire Ukraine conflict. I think that Trump is definitely looking for Europe to buy more U.S. LNG, and then also defense. So I think one of the things that plays into Trump talking about lowering U.S. defense spending is also having other countries, including India, including Europe, buy more U.S. defense products and equipment. And so that, I think, also kind of goes into this piece where they're trying to get Europe to pay more for its own defense and be less reliant on the United States, but still purchase more things from the United States.
Jeannette, we've been speculating about some of these proposals for a while. What specifically did we learn yesterday from a proposal that was really light in details?
So I think the point is that this could also be one of the things that I thought was very interesting is that Trump did say this might be somewhat of a replacement for his universal tariff that he proposed to do a 10% tariff on all countries. This is a way that they have a new trade law that they're using. It's obviously it's an old trade law that hasn't been used, but that's where they're looking to actually apply this. But it's saying that this is also more of a one-on-one basis, saying that whatever that country's tariff rate on the U.S. is, if they lower it, that is an ability to avoid the tariff or to change other non-tariff barriers that are impeding U.S. trade. So it shows that there's actually a lot of room for negotiation, for changes to avoid these tariffs from going into effect, and also shows that it could be done on a more one-on-one basis rather than a broad universal tariff. I think Trump is really trying to focus on countries with which the U.S. has large trade deficits. Those are countries like China, Mexico, Vietnam, Japan, South Korea, Thailand. Those are really probably where he's going to be focused. India as well, actually. But those are where he's going to be focused on, and then he can kind of move on to other countries. But I think that is kind of what we saw as a little bit of a change there, where you see it could be a little bit less broad in the sense of going after the entire, all imports coming into the United States, but also still shows that there is this room for negotiation.
Just quickly, markets are taking this as an idea that maybe this president doesn't want tariffs for tariff's sake to raise money. Do you think it's fair to discount that at this point?
So I think he does want tariffs for the revenue purposes. Obviously, the Congress does have to pass a large tax bill. Congress is not going to legislate on tariffs, but having that revenue come into the Treasury is certainly something that he can point to say that this is not going to cost as much as it has been perceived, especially when we're looking at the deficit concerns, particularly coming out of the House conservatives. But I do also think that it's not that he wants to necessarily have tariffs in place just to have tariffs in place. He wants changes. He wants other countries to make changes that are more beneficial to the United States, saying repeatedly that he thinks that the U.S. has been treated poorly. And I think that is more ultimately his goal.
Jeannette, appreciate the update. Thank you. Jeannette Lowe there of Strategas. Joining us around the table, Lindsey Piegza of Stifel. A whole bunch of headwinds have held back the consumer sentiment. We've seen that be hit in the last month or so. Is it hurting spending?
Well, clearly, I think this number really starts to poke some of the holes into the thesis that we see this ongoing resilience of the consumer. Now, broadly speaking, we continue to see the consumer spend in the marketplace on goods and services, but it's that loss of momentum. It's that second derivative decline of the consumer slowing the pace of still positive expenditures. Now, Lisa, as you pointed out, a lot of this weakness is offset by earlier upward revisions to prior months. That being said, there are clearly still challenges facing the consumer in this environment of higher prices, higher borrowing costs, the resumption of student debt payments. There's still a lot of challenges facing the average American and the average household balance sheet.
I feel like we're whipsawed in terms of a narrative every day. One day it's weakness that potentially could be the biggest headwind to the market this year. The other, it could be inflationary and an upward growth shock. Which is it?
Well, I think it goes together. I think inflation is one of the biggest challenges that we're seeing weigh on consumers at this point. As consumers are forced to face this burden of elevated prices as they have been for years, that's going to continue to erode their ability to spend in the marketplace. Now, we've seen consumers turn to many of these one-off scenarios, buy now, pay later, turning to credit cards with balances over now $1.2 trillion. But as that burden continues to increase, that's going to ameliorate their ability to find these additional supplements to continue to spend at this pace. So we've gone from double-digit spending down to 8, down to 6. We're now averaging just under 3% since the start of 2023. That's still indicative of a solid 2% GDP pace, but if we slow further from here, that could start to add to the momentum of a stagflation storyline.
So the pushback that we get from the stagflation fears is if you actually look at the data inside of some of the inflation metrics, it's not that bad and it's steadily disinflationary and it really just matters core PCE, which is fine, and everything else is just noise. Do you agree?
I think we've seen a lot of improvement from earlier peak levels. I don't want to throw cold water on the improvement that we've seen, but we are not in a clear disinflationary environment at this point. As of last year, a lot of noise, a lot of volatility in the metrics, and more recently we've seen not just a move sideways, but upward acceleration for 4 consecutive months in the PPI and the CPI and some of the core metrics, the super core CPI, housing alone, double the 2% target. So with that acceleration, we expect the PCE and the core PCE to remain closer to 2.5%, which still perpetuates the concern then of choking off upside potential for growth.
We're dominated by headlines about policy changes that could be coming down the pike, and we are awaiting a discussion from J.D. Vance, and I'm wondering from your perspective how quickly some of what's being discussed could percolate into the economic data and backdrop that you're seeing.
Well, it can certainly add to the uncertainty in the marketplace. It can add to the uncertainty we see in consumer confidence, and I think that was in good part behind that drop that we saw at the start of the year. But in terms of filtering into the actual price data, that I think will be extended out probably about 6 months or so because businesses have already responded in anticipation of those tariffs, of those higher prices. So a lot of that inventory build has already been taken into account. So we're not going to see that filter into the price metrics for some time. But again, it will continue to cause near-term volatility and uncertainty.
Lindsey, it's great to catch up with you. As always,
Thank you very
Lindsey
much.
Piegza there of Stifel.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.